Hey there, it's Carl Pierre from Passive Workforce, the consulting firm that I co-founded to focus on the healthcare industry. We're all about helping you start, grow, and sell your company. And it's not just talk. My companies have done over $75 million in revenue, and at one point I've managed over 400 employees at the same time. Today, I wanted to talk to you about something that's important, business credit. Now, I'm not here to sell you on the hype on some sort of sketchy strategy like buying trade lines or anything like that. That's not what we do here. We're focusing on building credit the right way, the ethical way, for all business types, not just healthcare companies. We'll be discussing how to get business credit, how to use it to grow, and how to accumulate points for future use for things like travel. We'll also talk about raising capital for big purchases like new equipment or even acquiring other companies. Managing credit properly can really help take your business to the next level. So let's get into it and see how business credit can work for you. Now let's start with the basics. What's the difference between business credit and personal credit? You might think that they're the same, but there are quite a few differences that you need to know about. It's not just about keeping your finances separate, there's a whole lot more to it. Personal credit is what's going to reflect on your personal credit report. Okay, you're going to see your credit cards, your home mortgage, anything related to you as the individual. Now, business credit, what most people don't know, does not show up on your personal credit report. And it's important that those two are separate because ultimately, in the beginning, it's going to be your personal credit that's going to allow you to apply for business credit because your business doesn't have any history if you're just getting started. But the cool thing is all those initial expenses, any sort of debt that you're carrying on your business is not going to affect your personal credit worthiness. It's actually the reverse. Your personal credit worthiness is going to affect what sort of credit lines you could get for your business, especially before your business has its own personal or its own business profile. There's also different credit bureaus for business credit, like Dun & Bradstreet is one of them. A lot of people would recommend that you apply for a DUNS number just to start building your profile with them. For me, it hasn't really made much of a difference in what sort of credit lines I secure, so I really don't recommend that to people, but it is another credit bureau that some creditors will check against. So if you register with Dun & Bradstreet, you'll be able to kind of keep track of your credit profile there and make sure that all your credit from your business is accurately reported to Dun & Bradstreet. Also, there's Experian for Business. You're going to want to kind of check in with that from time to time to make sure that your business credit profile isn't reporting anything inaccurate. Remember though, your initial credit for your business is going to be based on your personal credit profile. So if you're trying to apply for business credit, you always have to make sure that your personal is in good order until you have substantial history for your business so that it can apply on its own. But the thing that I really like about business credit is that it doesn't reflect on your personal. And what some people do is that they'll use their personal cards to start processing things through their business, and they're carrying this huge amount of credit card debt, which ultimately lowers their score and then makes it more difficult for them to get business credit. So make sure that you're entering this properly and smartly, and you'll be able to secure the credit that you need and keep those profiles separate. It also helps to have the different accounts when it comes to managing your books. Your accountant is going to hate you commingling personal expenses with business and vice versa. Make sure that you have separate profiles and separate cards for each one of those entities. Remember, your business is its own entity. It has its own tax number. It's almost an individual and should be treated as such. Moving on, let's talk about startup credit. When you're just kicking off your business, a credit card could be a great tool to manage expenses and maintain cash flow. There are plenty of options out there, and I've got a few recommendations for you. I already mentioned that you're going to have two separate profiles, but when you're starting your business, what you're going to do is you're going to want to apply for business credit cards, especially with your home bake. Now, the credit cards that I recommend and that you have a high chance of getting approvals for are Chase Sapphire cards. That's going to be offered to you if you open up a Chase Business Bank account. The representative, I'm sure, gets a commission and they'll offer it to you. But the approval rates are pretty high and they start you out with a good amount of credit. And it's going to be based on your personal income and your credit report. So when you're applying, just make sure that your credit's in a good state so that you could get maximum credit line with that Chase card. Another card that I really like is the American Express Gold and Platinum cards. They offer amazing point packages right out the gate, and they're charge cards. So it kind of protects you from kind of running these outrageous debts. It's easy to get carried away when you're starting your new business, paying for all kinds of marketing materials, paying for ads, especially when it's on a credit card that they just gave you a $30,000 limit on. You could start diving through it real quickly. And when you have a charge card, you're going to be accountable for that charge at the end of the month. So it helps you control your budget a little bit better. But when you're getting started out, these are two cards that have pretty good approval rates and they offer you a lot of points. And the thing about the points is that, for example, I just got a new American Express offer for 130,000 points if I spend $15,000 in my business in the first 3 months. With 130,000 points, I could get a few flights, probably 3 or 4 flights in the United States for myself. So it'd be great for business travel or personal travel. And as your business grows and you're covering things like workers' compensation insurance, electrical costs, utilities, all kinds of promotional things, you're going to be able to build points really quickly. And that's going to help you kind of manage your business travel. All right, next up, we're going to dive into something called specialty lines of credit. This could be particularly beneficial for our industry, especially when it comes to staffing. Let's break down what this is, how it works, and why you might need to get your own specialty line of credit. Specialty lines of credit are credit lines for specific things. And what we tend to use in the healthcare space, at least in healthcare staffing, medical staffing, are factor lines of credit. These are advances on your receivables. So let me just explain how that works. Let's say you did about $100,000 of billables on nursing salaries, right? You're going to have to pay those nurses probably on a weekly basis, but you're going to get paid 30 or 60 days later from the hospital, nursing home, etc. If you're just starting out, it's going to be hard for you to swing that payroll from your pocket or from your cash reserves. So these specialty lenders, like factors, will pay you a percentage upfront of your invoice. If it's $100,000, they'll usually pay you between $75,000 and $80,000 on that invoice, which will allow you to pay payroll, keep your overhead going, and then when the money comes in, they receive the $100,000 payment. They usually take about 2 or 3% off the top, and then they pay you the balance, whether it's 17% or a little bit more than that, to make you whole. So it's costing you about 2% to 3% per month, more or less, but it allows you to maintain liquidity so that you're able to meet your obligations. So if you're starting out in medical staffing, home health care, you even started a medical practice, it might make sense for you to set up one of these lines of credit, and we can help you with that. If you're finding this information useful, please do me a favor, click that like button and also subscribe to the channel. If you are starting a business with a partner, make sure you share this video with them as well. All of these actions really help our company be seen on YouTube. So please, and thank you very much for that. Now, let's say your business has been around for a while and you've got at least 2 years of credit history under your belt, tax returns and financials. This is where traditional revolving lines of credit can come into play. I'll explain what this is and why it might be the right next step for your business. Now, a traditional line of credit is different from a specialty line of credit because it is a true line of credit. The specialty line of credits are unique for industry groups and for specific things, but a traditional line of credit allows you to draft against this credit line for whatever you need. And the thing that's really good about lines of credit is that whatever you draft is what you're accumulating interest on. So let's just use that $100,000 example again. You may apply for a $100,000 traditional line of credit, and from month to month, you're not using this line of credit. But all of a sudden, you've got a new contract or a new vendor that you're servicing, and they're going to be on this trailing 30 or 60 days. Your traditional line of credit is usually going to be about prime plus 2 or 3%. Right now, that might be about 8 to 9% interest per year. So if you compare that to the factors that are charging you 2 to 3% on a 30-day basis, on a yearly basis, even if it was 12%, you're only paying 1% per month. So it's the cheaper money. And you're only paying on what you draft. You might only need to draft $30,000 or $20,000 at first to meet the demand of this new contract. And you're only going to get charged interest on that for whatever period that you have that cash flow delay. You're also not limited to just using that line of credit for payroll, or you're not going to be limited in that you're only going to get a line of credit based on your invoices. If you want to use that line of credit for marketing dollars, for ad dollars, or for anything in your business that you feel that you need, you're going to be able to do so. Most traditional lines of credit are linked to checking accounts, or you have to draft an amount from your line of credit and move it over to your bank account. So you could use it like cash. It's almost like getting a cash advance on your credit cards, except they're far more versatile and useful, especially in the industries that we're in. Now, the only downside is that they're not easy to get. Again, because they're not secured by anything besides the performance of your business. So you're going to need good financials going to your traditional bank to get one of these traditional lines of credit. They're going to want you to have good credit. They're going to want the business to have good credit. And they're going to want to see that your business is cash flow positive for at least 2 to 3 years on your tax returns. A lot of people think that it's a smart idea to expense everything out and have a low tax burden from year to year, even though they're running a profitable business. Now, the problem with that is when you go to apply for traditional financing, they're going to believe that you don't have the cash flow to service your debt, and whatever they're going to lend to you is going to be based on that. So just from experience, it sucks to pay taxes, but it's also beneficial to show positive cash flow on your tax returns because it's going to open the door for better credit lines and better credit options. Okay, let's shift gears a little bit. What happens when you need to buy something big, like a big piece of equipment? A term loan could be a good option, and I'm going to tell you why and how you can secure one of these term loans for your business. Applying for term loans are going to be similar to applying for lines of credit. It's going to be highly dependent on the credit profile of your business, that your business has good credit, that it has cash flow that's demonstrated in your financial reports and on your tax returns. And these loans are structured for long-term payoff. They're going to be best for acquiring equipment. They're going to be good for acquiring and developing your office space if you needed to build out your office in a unique way. They're going to be good for any sort of major purchases, cars, purchasing another business, etc. Now, the thing about your term loans is that regardless of how you use the money, you're going to be accumulating interest from day one, and you're probably going to have origination fees. So you need to make sure that you're going to use that capital. It doesn't make sense to apply for a term loan if you're not going to deploy the capital. If you just want to have access to capital, that's when the credit line comes in. But when you know that you're going to be making this major purchase, that's where the term loans come in. They're fixed, usually fixed, and for a certain amount of time, so it's predictable. And what the bank is going to be looking for is whether the cash flow from your business can easily service that debt. They usually want you to be at like less than 25%. Some of them are going to be at less than 40% of your cash flow to service your monthly debt. So I'll give you a quick example. Let's just say your business is cash flowing $20,000 a month. Most banks are going to be comfortable creating a term loan that allows you to have a payment of $5,000 a month, right? So it's only 25% or so of your cash flow, and it's not going to be a drain on your company to produce that. And that probably is going to get you around the $200,000 mark as far as a term loan is concerned, if you're going to have a $5,000 a month payment. But again, you don't want to borrow that money if you don't have a real use for it. Now, I just want to give you one little strategy or one little tip that you could use that could really be a smart way of managing the tax situation in your business. There are certain pieces of large equipment and certain purchases that qualify for accelerated depreciation. Meaning, you could buy a piece of equipment that's necessary for your business that could be expensed out in 1 year rather than capitalized over 5 years like most pieces of heavy equipment. And if you were to buy like a $100,000 piece of heavy equipment, you would be able to accelerate the depreciation in the first year and write it off as an expense in that year. So even if you had a $100,000 profit and you borrowed $100,000 for this piece of equipment and you bought this piece of equipment, you would be able to deduct that out against your $100,000 profit and have a net zero tax burden. So when you're thinking about strategizing to offset that tax liability, you want to kind of do so strategically so it doesn't affect your credit worthiness and you're not just spending money on crap. So that's another way that you can use a term loan in a smart way. Lastly, let's talk about big moves, leveraged acquisitions. If you're ready to grow through acquisitions, knowing how to raise a large sum of money can be a game changer. We'll dig into how leveraged acquisitions work and how you can use them to catapult your business to new heights. For more advanced entrepreneurs and businesses, leveraged buyouts are probably going to be the best way for you to grow your business. Now, the way a leveraged buyout works is that you're using the credit worthiness and cash flow of the business that you're acquiring to qualify for the debt. So let's say you're buying a $1 million home care agency. That's what it's selling for, okay? Or a $1 million staffing agency. You can actually pay for the loan through the cash flow that the business is showing. If that business is selling for $1 million, it's most likely doing between $200,000 and $250,000 in annual cash flow. So in a leveraged buyout, you're expected to pay the loan off from the cash flow of that business, showing the bank that this business for the past 3 years has been doing $200,000 to $250,000 a year. Using a 10-year term loan, you'd be paying out of the cash flow to service the debt of acquiring the business. Now, what ends up happening is about 40 to 30% of that cash flow is going to be consumed by this new term loan, but you're going to be buying additional cash flow and additional business. Now, this may be smart if you're expanding into new territories or if you are just consolidating services. If you buy a competing home care agency or you buy a competing nursing agency, they still have all their coordination staff, their HR team. There's going to be some duplications that you could strip back and increase the cash flow from. They may have contracts that are highly lucrative for you that they weren't really exploiting. Let's just say they had a really sweet hospital contract that allowed them to staff x-ray techs, OR staff, etc. And they were only staffing nurses because that's what they were comfortable with. However, your agency is a radiological agency and they're not taking advantage of all of those radiological positions. If you were to purchase one of these companies, you already have the bandwidth of employees that you could place in that facility and probably max out on that contract. So if you're going about purchasing businesses strategically, you're going to want to use debt to do these leverage buyouts and expand your portfolio or expand your service area through leveraged buyouts. When it comes to lenders for these sort of deals, there's plenty of them, surprisingly, right? Before I started getting into this side of the business, I didn't think there were as many lenders as there were. But for those of you who are doing your first deal, you're probably going to be using SBA financing. Actually, when you're looking at listings for businesses being sold, a lot of them come pre-approved for SBA financing. And SBA will usually lend you up to $5 million as an individual. So you have $5 million of business purchasing power if you use this strategy through the SBA. The lending parameters are actually pretty good because you could get away with putting as little as 10% down to make that purchase. And some of the other lenders are going to expect you to come up with about 20 or 30% down. Now, you might be thinking, how am I going to come up with this money if I'm just getting started? One of the ways is to raise capital through friends and family or tap into your savings to meet that cash requirement. So again, using the $1 million example, if there's a $1 million business that you're buying and there's a $100,000 cash requirement, you could use your cash, $100,000 if you had it, or raise money from friends and family to meet that $100,000 cash requirement and get approved for that loan. All right, that's a lot of information to take in. But remember, understanding business credit and using it responsibly can be a powerful tool in growing your business. Whether you're just starting out or planning a major acquisition, this knowledge can be invaluable. If you need help securing some credit for your business, feel free to reach out to someone on my team. You could meet with me and we could talk through it to figure out your situation. Don't forget to like, subscribe, and I'll see you in the next video.